Good morning, ladies and gentlemen. Of course, I'll also say good afternoon to those of you who are here joining me on the East Coast. It's just after 12 noon Eastern Time. And welcome to today's presentation. Let's make a proper protected stock trade. We're going to look into the proper setup of a radioactive married put position. For those of you who don't know me, my name is Mike Chupka. I'm the Director of Education here at PowerOptions and at RadioActive Trading. And as many of you may have heard or may know already, I do actively trade this strategy with a large portion of my portfolio. About 50 to 60% of my portfolio is allocated to these techniques. And we're going to talk about the proper setup, why we use it, why this might be important for you to use in your portfolio as well. Now, we had a fantastic year in 2019. If we, of course, just look at the broad market in general. SPY, QQQ, RUT, all of them were up. And we see here SPY from the beginning of the year is up about 28% as of the close of business yesterday. And it's actually up 35% from that disastrous low we saw at the end of last year on December 26th, 2018. Well, we're not done yet. We still have 14 more days to go. Anything is possible. And of course, this was much better than what we saw in 2018. But along the way, in 2019, it wasn't all roses. It wasn't all perfect. We did have some issues along the way. We had some small hiccups here with some 10, 12, 15% declines. Beginning of August 5th. Saw a little bit of a hiccup in October as well, and then we had a great run after that. 2018, of course, we were looking pretty good up until the beginning of October, and then we saw that 3-month disastrous decline to the end of December 26th, and then, well, we've just had a fantastic year this year as well. Thankfully, if you were bullish. Not all stocks perform this way. You always say that, the rising tide lifts the boats. We've seen some big stocks have some disastrous moments. Here's a chart of the last year of M, looking at Macys. Terrible drop after that first earnings, the steady decline down. That's at about 50% decline, a little bit more from where it was at the beginning of the year. And some stocks we even saw a little bit of a roller coaster going through. Here's another standard stock, GM. We watched it run up to 41, almost 42, but in between there it was jumping down to $33, $32, back down again, tried to make a little run, and now here we are down at the bottom. It's interesting, though, if we got in at the beginning of the year, at around $32, $33 per share, we'd probably have about an 8, 9, 10% increase if we just held through this. However, I'm sure most of us would have closed, adjusted. But this is the kind of charts that sometimes it's disastrous for a covered calls trader. If I was investing in GM and I thought it was bullish, I get in here at the beginning of the year and I sell maybe an out-of-the-money 33 or 34 call, well, I may have to roll it and then roll it again. But hopefully you wouldn't have done it around this jump around earnings. Things are going good, you're rolling up your call, you're adding to your cost basis on the stock, and then this happens. Okay, so what do? Now I'm going to sell calls at the lower ranges to make it up, but now it goes back up. I got to buy them back. Add back to the cost basis, and now we have this steep decline, and I'm selling lower strikes, lower strikes, lower strikes, not making up the full loss, but getting a little bit of premium, and then now I'm rolling back up and adding back into the cost basis. Up and down, type of roller coaster that can be stressful for any strategy, unless you had maybe just bought a year out straddle or strangle and were playing the long calls, selling to close, buying to open, and so forth as we went through the year with the ups and the downs. And then, of course, some stocks, you have the best and worst of both. This is actually a position I'm in the Fusion portfolio at RadioActive Trading, a Dell position, which had a great run going into January, then some disastrous times, then another great run as well, and then a pullback. And a lot of this was related, of course, to outside forces, tariffs, and other things that are beyond the control of what we can see on the chart, what we can see of the company information, the raw data for fundamentals and technicals, just things that are taking a good stock down in price from outside forces we can't control. So it's not always that the rising tide lifts all the boats. And the issue now is that what can we say as a positive or as a known going into 2020? Well, we don't know what 2020 is going to have in store for us, but again, I plan to be prepared and I plan to be protected with growth stocks and strong stocks in my portfolio, but with the proper protection in place. Now, of course, this is why we have different option strategies that we can use. We can sell premium against stocks, do covered calls, maybe even cash secured naked puts. But you can kind of see how that would cause a lot of problems in some of those three stocks we just reviewed. Yes, we can buy calls and buy puts and try to get the timing right. As soon as we see a trend, buy some calls. When it looks like it's topped out, close those calls for profit, buy puts, and just trying to manage up and down. But a lot of times the signals that we've seen in the market happen quickly, and you would have been glued to your computer or to your phone a lot, trying to pick the right moments when that sell signal or that buy signal came in, getting in and out of positions and moving back and forth. Of course, credit, debit spreads, the vertical spreads, great way to use leverage. I do use credit spreads with a smaller portion of my portfolio because of the risk that's inherent with those strategies as well. We can try to play the percentages, we can try to play the technical runs, but again, we do have these other option strategies, but the timing and of course the unknown makes it very difficult to profit long term. But let's talk for a minute about what you saw in 2019. I just want to get a base here. What was your trading year in 2019? Did you have a great trading year where we were above the 28% return we saw in SPY just as we had bought and hold over that time period? Did you have a good year? You hit your targets, of course, for your yearly return with the strategies that we're using. Did you have maybe a profit or a small loss, but not as good as you hoped? You're in that category of not good, some gains, some losses. You're sort of below break even at this point. Or did you end up having a terrible year because of management, because of the sudden swings that did happen during those different market cycles? So I just want to leave the poll open for a little bit here. So far, it's looking pretty good. No one has actually answered terrible yet, and that is very encouraging. All right, so we still have some votes coming in. I'm going to leave it open just for a little bit. About 70% of you have already voted, so I'm going to see if any other stragglers come in and offer their opinions as well. All right. All right, ladies and gentlemen, let's close the poll, and of course, let me share the results with all of you. 13% had a fantastic year. You've got a return of over 28% return that was seen on the SPY of just buying and holding. Fantastic. 38% of you said that you're doing pretty good. You hit your target goals for the yearly return, maybe a little bit better. Fantastic. Now, a quarter of you, 25%, said you had some profit, but maybe not as much as you were hoping, not as much as you were maybe promised by a service. Some places out there say that you can make 3 to 6% per month trading covered calls. I've even seen services offering 15% returns using credit spreads on a 5-day basis. That's a little tough to get consistently. Believe me, I've tried. I have a subtly different approach. But still, ahead of the game a little bit, not doing too bad. And 25% of you said you're not doing too good. You had some gains, some losses, but you're below break even. And thankfully, no one said that they had a terrible trading year in 2019. And just out of curiosity, what option strategies did you mainly use in your portfolio? Now, I know you might have done more, but I just allowed this to select one answer. So tell me which strategy maybe made the bulk of your position, the bulk of the options trading in your portfolio. If you don't see one you're using here, feel free to use the question pod to send me what strategy you were using. I couldn't include everything, but I tried my best. But were you mainly doing buying calls and puts, maybe doing straddles and strangles? Were you doing the covered calls and covered puts, income generation? Were you doing the vertical spreads, credit spreads, debit spreads, maybe even iron condors possibly as well? We can throw that in there. Were you looking at time spreads? We mean the calendar spreads, diagonals, or even horizontals in that case. Or are you more doing the neutral positions, some butterflies, broken wing butterflies, or more? And again, if there's a strategy that you were using, even if it's something obscure, you don't see it here on the list, but you want to chime in, just use the question pod there. Go ahead and just give me a little bit of the strategy that you're using. Now, of course, like I'm sure many of you, like myself, applied a couple of these different strategies. As I already mentioned, the main one I was using was the married put techniques following the RadioActive Trading portfolio, with some credit spreads in there with about maybe 15% of my total portfolio, and some straddles and strangles around earnings, occasionally some diagonal spreads as well. This is an interesting break because, of course, I did just ask what were you mostly doing in your portfolio. You've had this open for a minute. I want to move on. No one said that buying calls and puts or maybe doing straddles and strangles represented the bulk of their portfolio. Well, that's good. The leverage strategies can cause problems. We're going to take a look at why in just a minute. But we'll focus more on this idea of covered calls and naked puts. 63% of you said that you're doing mostly covered calls and naked puts. And we had roughly 51% of our audience, that 13% that said they were doing great and that 38% that said they were doing good, over the last year of 2019. But 63% of you were doing covered calls and naked puts, and 38% of you were doing the vertical spreads, credit spreads, debit spreads, and more. Okay, no one said they were doing time spreads as the main portion of their portfolio. No one said they were doing neutral positions. Now, we had some great success. Half of you did great or good in last year's market, and about half of you were not so good, a little bit meh, some profits, but not enough. Why don't these common strategies that did work in 2019, as we just saw, but why don't they work as promised? And one of the main reasons is that we as investors sometimes don't pay attention to our trading plan when things are going really good. We divert our attention when those covered calls are doing really well. Maybe we take on a little bit too much risk. Maybe we get overzealous and invest too much in that one position that looks really good with the highest return. But in general, these promises that we've seen by products out there that sometimes I feel are irresponsible, that promise 3 to 6% return per month with covered calls or with naked puts, or 20% returns using out-of-the-money credit spreads every 5 days on a weekly basis, where if you look at it, that's almost an 80% return per month. I don't know anyone who's making that honestly, realistically. But a lot of these strategies don't work long-term as promised because of what's known as gambler's ruin, the martingale. And what we tend to forget is that even with proper position sizing, and even with stop orders, which are just assumed insurance, if we hit a 10% loss on a position, we don't need a 10% gain to get back to break even. We need an 11% gain to reach where we started. I invest $10,000 into a covered call. Regardless of the premium that I get, the stock falls, I take a 10% loss. So I'm now at $9,000. If I get a 10% gain on my next position, which is unlikely with a covered call trade, but now I'm just back to 9,900, I'm still shy of break even. And the slope becomes more and more slippery. If you take a 20% loss, now we need a 25% gain to get back to break even. One of those unknown events, an early earnings warning announcement or something along those lines, you suddenly see that 33, 35% decline on your stock overnight. Stop order can't help you. You now need a 50% gain on what you have left to get back to where you started. And naturally, of course, 50% loss is going to lead you to need 100% gain on what you have remaining just to get back to square one. But controlling losses, if I suffer only a 5% loss on a position, I now only need a 5.3% gain to get back to break even. And that potentially could happen in a month. It's much harder to see an 11% gain, 25% gain, or a 50% gain on a consistent basis when the trades don't work out as you want. Now, I want to take a look at our two popular strategies in action. We're going to navigate over to RadioActiveTrading.com, and I want to take a look at what's called the Trade Simulator tool. And what this tool does, it's going to simulate sort of a trading plan for us. It's going to take a look at our targeted return for a strategy, what we might set as a loss limit. We're going to be able to set our probability of winners and losers. And we're going to be able to set a starting amount and an allocation to see a rundown of what our positions would look like long term with a series of wins and losses. So let's navigate right now over to RadioActiveTrading.com. And on RadioActiveTrading.com, we're going to click on the Resources tab up here at the top. And I'm going to take a look at this Trade Simulator tool. Now let's say that we have a given strategy. Let's just take covered calls. And we take that higher end of the promised expectations, which might not be realistic. And we're going to assume that when we get assigned on our covered call, or let's even say the premium we generate is about 3%. Now at the same time, we're going to follow some of the popular discussions from things such as IBD and more, and we're going to use a stop order of about 7% on our positions. Now we're going to assume that we're going at the money, maybe slightly in the money, to hope to get a sign and make this 3% return. We're going to assume we have a decent track record, so I'm going to knock down our probability of loss to 30%, meaning 7 out of 10 times we're going to make that 3%, and the other 3 out of 10 times we're going to lose somewhere in the 7% range. Now let's say I just started out with $10,000 allocated to covered calls, and I'm going to put in 50%, $5,000 into each covered call position. Let's say every cycle, month by month. Well, down below we have our record. Take a coin, flip it 100 times. Heads we win, we make 3%. Tails we lose, and lose that 7%. Now this isn't too bad actually. This would be a 25% gain, close to the maximum or close to the high that we saw in SPY, but a little bit below. We follow the strings of winners and losers as we flip the coin 100 times. But did we have to be right 70%? No. To get around that 25% return, we had to be right 75% of the time. If I'm only right 72% of the time, just a little more than 7 out of 10 times, we don't have a big drawdown on our portfolio, but we don't end up with a win. Well, we end up with a win, but just a small win. It's only about 7% or so from the $10,000 we started out with. And that would assume after 100 trades. Seems like a lot of work for a 7% return. I know most of you did better. But it gets tricky. Even right around 7 out of 10 times, just a little bit below 7 out of 10 times success rate, you almost see a 21% drawdown in the portfolio, and we have a small loss on the position of about 8%. And what we use for covered calls to allocate it. That's sort of the gambler's ruin in action. Now, of course, we could say, well, what if you just allocated a quarter? Well, of course, we could change that here, invest a trade, open 4 trades, we'd get to 100 trades faster. And we'd probably see less sizable losses, but then in the allocation, what else would we see? We'd also see less sizable gains. That 3% win wouldn't be as much as our portfolio. 3% on a quarter of the amount of money, or half the amount of money, wouldn't be the same return that we'd see to hinder those lower losses as well. We'd end up close to the same, but maybe a little bit better. Credit spreads. There's a second popular strategy with selected in our poll. And when we think about an out-of-the-money bull put or bear call credit spread, you might be looking for something with a 75% probability with a target leverage return of about 15% or so. Now, I'm looking to maybe make, let's say, 55, 60 cents on a 5-point spread, maybe 30 cents on a 2 or 2.5 point spread. That would get me to that about 15% return. Now, unfortunately, if a stock falls 5, 6, or 7%, especially if I'm doing weekly spreads, this might put me at a 40, 50, or 60% loss. And I'd probably close that spread position before it got to 100% because that's going to wipe out 10 or 12 previous trades. So I've got to control that, but the market dictates it more with these leverage strategies. Trust me, I know. I use it with 15% of my portfolio. So we're going to put the loss limit at 50%. So if I opened a 5-point spread, stock fell against me from an unexpected event, I'd close for only a loss of maybe $2 or $2.50. Now again, I'm going to be looking for a higher probability, one of the advantages of those out-of-the-money spreads. So we're going to set this up to about, let's say 25%, 75% probability or higher. Now, I'm not going to allocate 50% of the $10,000. I might be allocating to spreads. And this, by the way, if I was allocating $10,000 to spreads, it'd be in a portfolio of maybe $80, $90, or $100,000. Only 10 or 12 or 15% of my total portfolio would be allocated to the strategy. You can already see why down below. So let's drop this down to about 25%. Okay? Now I wanted a 75% probability. I get a 70% probability. We only got to about a 16% return. Wow. It's dangerous, isn't it? I need to be right 75% of the time to profit. Even here, with the strings of wins and losers, although at one point we might have seen a 40% return, 39% return, we also have a 30% drawdown and end up about 21% down in the portfolio. That's being right 75, 76, 77% of the time. We actually have to be right a little bit more or provide more allocation. You don't hit that target, the 75% win ratio, things are looking pretty grim. Okay, let's get a good one. There you go. Right 85% of the time with these values, and that's what you're looking for. Low drawdown, very high return on your investment. That's what's possible. But I need to be right 75% of the time. Did I need to be right 77? No, I need to be right closer to 80, 85% of the time in order to profit long term. And most of the time, if you're looking for the spreads that do offer that 85% probability, you're more in the range of an 11, 10% gain rather than 15 to 20% gains as well. That's the lie of leverage in action. Those losses start to pile up. Now, this might seem very simple, but at the same time, it's necessary to understand why we need the proper protection in place and why we need to set up a proper protected stock position for the bulk of our portfolio heading into the unknowns of 2020 and beyond. So that was the Trade Simulator tool in action. Play with your numbers later on this afternoon or this week. Go to RadioActiveTrading.com. Click on the Resources tab. Go to the Trade Simulator. Put in your target returns for your strategy, the target loss limit you're using, whether you're using leverage and credit spreads or covered calls or naked puts. Put in your win ratio and see over time, over 100 trades, is this going to work out for you? Is this projected to be successful long term? And if not, you know you've got to change some numbers. You've got to change some structure, or maybe look for the proper structure as well. Now, the radioactive trading techniques, that initial structure we start off with, is a married put strategy. There's nothing new and exciting about that, but it's a married put strategy done in the proper way. And let's discuss what the proper way is. The proper structure follows the three core principles of radioactive trading, but really it applies to any option strategy: covered calls, spread trades, buying calls and puts. What we want to do first is we want to force an ideal size trade. We want to make sure that we have proper position sizing and that we save ourselves from over trading, even if the market looks strong, even if we say we know the stock and we've been trading a certain strategy against it for months and months. We know what's going to happen if the unexpected happens. Well, unfortunately, we don't. It saves us from over trading. One of the second three core principles, the at-the-money bell curve. Options on a stock, underlying security at any expiration date, the at-the-money option is always going to have the highest time premium. And that's where we want to be selling to maximize the return. But when we're buying, we don't want to buy into the highest time value. We want to look at something else. And of course, the time decay factor. Looking at options further out in time, they have a higher extrinsic value, a higher time value. But those options decay more slowly than the near term. Also, options that are further out in time have a higher up cost front, but a lower cost per day. And that is essential. So forcing an ideal size trade, whenever I open a position, in addition to forcing the controlled risk, which the married put radioactive trading structure does for me, done correctly. The allocation is also key. We just saw that on the trade simulator tool when we looked at the credit spreads. If I was using 50% of that $10,000, we were seeing declines even with a 70% win ratio down to $830. We're at a 97% loss effectively, 92% loss. So we need to do more allocation, but 25% in, 10% into multiple trades and spread it out. Now, the great thing about the radioactive structure, done correctly, is it forces me to only risk 4 to 8% of what I invested in the position. But I'm still going to do a second layer of protection, much like I do with my bull put credit spreads, to make sure if I do take the maximum loss for some unforeseen event, that only represents about 2% of my total portfolio value. So let's take a look at that. Here is how I would structure a proper protected stock position. This morning, Fabrinet FN is trading at around $63.85 per share. I could go out and buy shares of Fabrinet at $63.85, and then I'm going to look to buy a July put option. That's 230 days out in time. And I'm going to buy a 70 put, which is roughly $6.15 in the money. Now, it costs $10.25, but I'm guaranteed to get that intrinsic value back even if the stock does not move in the next 2, 3, or 4 months. But I have 8 months of protection available. Now, my total investment, of course, is $74.09. Buying those stock, paying $10.25 for that slightly in-the-money put option. Remember, we bought the 70 put. So I'm guaranteed to get $7,000 back, even if in the next 4 or 5 months, Fabrinet pulls a Macys and is trading down at $35, $36 per share, or worse. The put gives me the right to force someone to buy my shares of stock at 70. So even in the catastrophic event of poor earnings that I might cross, and that stock drops 35, 40% for some unforeseen earnings failure, the most I can risk on my investment is $409 or 5.5%. Now let's say I had $40,000 of my portfolio allocated to radioactive trading and the married put proper structure. That second layer of protection would dictate I could do about 200 shares of stock, and I'd buy 2 put options. So my maximum monetary risk is $818 of the $14,000 I've had invested in the position. So even if, again, for some reason I take the maximum loss on the trade, that's no more than 2.3, 2.4% of my total portfolio value. I'm still holding about 97% of what I started with in the worst case scenario. Now again, you say, oh, well, you've got this high price of $74.09, you've got such a low probability of the stock reaching $74.09 to the break even. And you'd be right. If I held it all the way to July expiration, made no adjustments on the position, and assumed that I was just going to wait to see if it goes up in price. But just like buying a far out long call position or a long put planning on a downtrend, the minute I open this position, I'm not down $409. I'm not $400 behind the 8 ball. All I'm risking is the bid-ask spread at this moment. I could turn around and liquidate the position and only lose maybe 5 or 10 cents, $5 or $10 total. I don't start to see a loss on this position until the stock starts to fall against me, or maybe I hold it too long and that time decay does kick in. But again, that's the second layer of protection. The first is I'm automatically forced into a deal size trade where I can't lose more than 5%, much better than a stop order, much better than that 7% suggestion made by some of the other companies out there for buying stock or doing covered calls, because this is controlled. With a 10-15% overnight decline from an unexpected event, this is my worst case scenario at July expiration, 8 months away, if the stock's trading below 70. and all the time value has dissipated out as well. Now let's move on to our second core principle here, the at-the-money bell curve. You look at any option chain, calls or puts, any expiration. The time value at the at-the-money strikes is the highest. That's where the swell is. So what does that sort of tell me? Well, it tells me that when I'm selling, I want to be selling in this range. When I'm buying for speculation, for protection, or as part of a vertical spread that matches my other criteria, I want to be buying in the money or out of the money for the calls or puts on these outside wings to pay into the lowest time premium. The intrinsic value might be high, but I want the lowest time premium so it doesn't work against me. Let's take a look at this real quick. That Fabrinet position we were looking at just a moment ago. 213 days out in time, the stock's trading at around $64 per share. The 65 strike, priced at $7.20, but the time value is $6.43, or 10.1% for the at-the-money option. As I go deeper in the money with the puts, we see an increase in our price, but most of that is due to the intrinsic value I'd be guaranteed to get back. Notice the time value is decaying as we go deeper and deeper in the money. And same, of course, as we go deeper and deeper out of the money to the lower strikes. This is on the put, of course, as well. So that peak is going to be right at the money. Whether you look closer in, whether you look further out in time, it's the same. I jump out to November, 339 days away. Same exact process. Although the premiums are higher as we go in the money, that highest time value occurs at the money strike, and then we see it go down as we go in the money, less time to decay against us, or we go out of the money as well. So that's just part of the simple structure. Why would I be choosing to go slightly in the money on that Fabrinet structure by buying the 70 or possibly the 75 put? Because I want to pay into the lower time value. I don't want to buy at the money. But of course, comparing July to July, we looked at a potential risk of around 5.6, 5.7% with the July 70 put 213 days away on Fabrinet. Why wouldn't I pay less? Just buy a cheap, deep out of the money put for only 75 cents. Why pay $10.40? Why not go to the 40 and only pay $1.45? Well, because you get what you pay for. Remember that steep curve that we saw? The gambler's ruin. Yes, this costs much less, but look at the maximum risk. Almost 40% if I bought the 40. Okay, I pay half of it and buy the July 60. That's a 13% maximum risk if the stock falls, and that's not really that deep out of the money. A small correction, Fabrinet could be below 60 very quickly. I might be looking at a 12-13% loss on the position. What does that mean? Probably means I'm going to need an 18 or 20% gain to get back to break even on the money I have left. But up here, in that scenario, if the stock falls and I only take a 4 or 5% loss, what do I need? Only a 4.5, maybe 5.3% gain to get back to break even, and that's much more respectable. Investors teach the married put as buying something cheap, out of the money, maybe 1 month out in time, but you see you get what you pay for. You know, this option's 30% out of the money here with a 32% risk. Here's a 25% risk, 22% of the money. Well, if I did all of my research, I used all my good fundamentals and all my good technicals, and I found that strong stock that was trading well, do I really even need to concern myself with a 50% decline? Oh, what about Macys? What about other stocks that we've seen this year that have gone up and down and sort of hit 25, 35, 40% loss? Is it worth it to buy cheap insurance for something you're planning to have a bullish run in the case of the unexpected happening? Or on a group of stocks where you expect the trend of 2019 to continue, but something happens in 2020 and we see our trends change rapidly in the first few months. That's why I have to worry about a 50% decline, even a 30% decline, or a 25% decline. The proper structure protects me from those things I cannot see. And finally, the time decay curve. This also dictates to us when we're selling premium, when we're looking to generate income through those credit spreads that 38% of you said that you were doing, even the covered calls, we want to be here, don't we? We want to be selling 30 days out in time, maybe 14 days out in time, maybe weekly, 5 to 7 days out in time as well. We want that time decay to work in our factor quickly, assuming everything works to our benefit. If I'm bullish on a position because I think the market's doing really well, do I want to buy a call that's 5 to 7 days out in time? Not really, unless I'm extraordinarily confident. I want to be buying out here, or maybe out here, because if the stock doesn't do what I expect in the first 10 to 15 days, I'm seeing a smaller decay on that position. Whereas if I buy a 30-day out option again, might look cheaper, but as soon as I get into it, I'm expecting to start seeing that rapid time decay work against me, whether I'm buying calls speculating on a bull move soon or puts speculating on a bear move soon. When we're buying, we want to be buying further out in time, not only to give the stock or the underlying more time to move in our desired direction, but also we lose less as time goes on. So again, it's a little bit more difficult of a graph, but why not cheap and near term? It's because of the decay line. It's because also of what we expect, and we know that the option that is 5 or 6 months out in time is not 6 times the cost. Now, I'm highlighting that 70 strike put on the right. We're looking at our July series that we showed the profit and loss chart for. On the left, we're looking at January, just 31 days out in time. That 70 put, roughly $6 in the money, has a small price of $6.70. Now the max risk in that one is only 59 cents, or 0.8% risk. Why wouldn't I go cheap and shorter term? This option is 8 months out in time, roughly. It's about 8 times the amount of time, isn't it? 31 days to 213. 7 days, 7 months, 7 times the amount of time. Is my option 7 times the cost? No. It's not $40. It's not $35. It's an even $10.40. It's only about $4 more, less than that, for 7 times the amount of time. Think about it this way. If I bought a January 70 put and I paid that $6.70 and the stock moved up to 71 and in 31 days this expires worthless, well, I paid 59 cents, 60 cents of time value. It's guaranteed to get the intrinsic back and the stock moved up for me. But now this option's worthless. I've lost that full $6.70. I buy a 72 or 75 put for February, risking another 60 cents. Now I'm at $1.20. I do that about 8 months in a row. Where am I? I'm at a risk of about $4.80 or $4.90. Whereas if I had just gone out in time first, I'd have a lower cost per day. And although the 0.8% looks pretty good, there's only 31 days with a January series to see a potential return. Here I have more time and a put that's retaining more of its time premium that I can use as a second asset to manipulate the trade, lower that initial at risk, or even lower my break even as well. So the proper protected stock trade, what do we want? We want the right risk. We want to avoid that slippery slope of gambler's ruin. I don't want to go cheap for 15 or 20% potential risk with an out-of-the-money put option to ensure a stock I'm planning is going to be bullish for an extended period of time. I want to put time on my side. I don't want to be buying 10, 15, or 30-day out put options that are going to start decaying very rapidly. I want to go at least 5 months, 6 months out in time to put myself on the proper end of that time decay curve. And I don't want to be buying at the money. I want to go slightly in the money or out of the money potentially to keep my risk low and to keep the time value low. But I don't want to necessarily go out of the money, and we already showed why. Picking the proper put to have the proper protected stock position is kind of like the 3 bears. Now remember, our stock's trading at 63.88. The 65 put doesn't have a bad price, but it's in about that 10% risk range. that might be a little bit too high, but if this was 8% or 7%, that would look pretty good. The one strike in the money, I'm looking at about a 5.8, 5.5% risk. That's right in the wheelhouse. And if I wanted to be more conservative, I could even go up to this level to a 3 or 4% risk on the position. Paying less and going further out of the money. Now we're risking that 15, 18, 20% potential, where if I do take that risk, we might need a 20, 25% gain on what we have left just to get back to break even. I want to stay right in that area, slightly in the money. I don't want to do the at-the-money option, which is the highest time value. That's the proper protected position to force us into an ideal size trade just on the structure alone and avoid that gambler's ruin going forward that we see can have an effect on our positions if you were doing even the covered call positions, even slightly in the money covered call positions, out of the money naked puts, and especially the vertical spreads. The application of the 3 core principles leads to the proper structure at hand. A controlled risk, knowing my monetary risk, of course, I could structure it with the allocation to make sure the total monetary amount is no more than 2.5% of my total portfolio value. Without doing anything else, I'm locked into an ideal size trade. I've put time on my side, and I went slightly in the money to give me that controlled risk following the ATM bell curve and the decay line as well. Of course, it still gives us a positive delta. The stock moves up 50 cents tomorrow or $1, my put would probably only lose 40 or 50 cents. I'm still getting a positive gain going up, and you can see that here by the curved red line, which is representing the position at the halfway point. My break even on this one is nowhere near that $74.09. It's only at about $65, $66, where I could start to hit the break even. But that's 4 months away. Tomorrow, if the stock moves up 20 or 35 cents, I'll have a 10 or 15% profit on the position. I wouldn't liquidate then, but I would still have a profit. I'm not 409 behind the 8 ball. I'm not 5.5% down when I open the position. Now, without getting into too much further detail, let's go ahead and pick a proper protected position. We're going to navigate over to PowerOptions. We're going to take a look at the default radioactive screens on the PowerOptions Married Put Search tool. I'm going to share with you some criteria I might change on that patented search tool to find positions that match my needs, force me into an ideal size trade, and follow the other core principles of really any options trading. I'm also going to discuss what I should not change, and we're going to talk about a little bit about the selection process as well. So let's go ahead now and navigate over to the PowerOptions suite of tools. And make sure I'm showing the proper screen there. And there we go. What we're looking at here is just the basic 14-day free trial to PowerOptions. And you can take the 4 steps here to get more familiar with the tools in the site. What you want to do now is we're going to go into the Married Put tab. This gives us some further education as well. But I want to go right into the search tool. And instantly we see some trades that just popped up. Now I've got some extra selections there made for my data columns for the different Greeks and so forth from other webinars we've done. But what am I looking at here? What I'm looking at here is the result of the proper structure, the criteria used to identify the proper protected structure as defined in the blueprint. I scroll down below the listed trades, and I have a field here where I can set the criteria for my options, stock technicals, stock fundamentals, and more. And what do we see just as a basic? Well, I'm forcing the tool to find me only positions that are at least 150 days out in time. Radioactive decay line, the time decay line. I want to be further out in time. Forcing myself into an ideal size trade, telling the system not to show me any positions that have a risk of more than 9%. But I also don't want to go too deep in the money. We'll talk about that on a later webinar. Going too deep in the money is going to lower your expectancy of profit, just like that 0.8% risk we saw even on a 30-day trade. For that time frame, that's too deep in the money. too low of a risk is also a bad thing. So we have some controls here not to go too deep in the money as well, and just some other basics to control the bid-ask spread. Now in each other category, we've got some technicals, basics of the stocks we would look for, average stock volume, volatility, I want to see some movement, uptrends, and more. I can set different things too. I can use other technicals, and then some basic fundamentals. What are the 3 things I personally might change on this default radioactive search to meet my needs? Well, the first thing is, I know my portfolio size. I know what I'm allocating to the positions. I don't know your portfolio right now. I don't need to. But if I'm only allocating, $35,000, $40,000, maybe a little bit less, I'm probably not going to be interested in stocks that are trading in $150, $120, $130 range. So I'm going to narrow this down. I'm going to look for stocks between, let's say, $9 and $120 per share. I might want to add some technicals. Just look for stocks that have a positive MACD crossover over the last day or so, or longer. I might even increase the average stock volume if I want to, but I'll leave that alone for now. What am I not going to change? I'm not going to change this time frame. If anything, I might increase it to force the system to find me puts that are at least maybe 180, 6 months out minimum or more. I'm going to adjust the risk factor, but not by lowering this lower level. I'm going to keep that at about 3.5%. Personal preference, I might not want to take higher than an 8% risk on a protected stock position, so I'll just change that as well. And that's really about it. Personally, you could make other adjustments in any strategy we support on PowerOptions, but I'm not going to change the time frame because I want to keep with the 3 core principles. I'm going to adjust the upper end of the risk to force myself into an ideal size trade. Radioactive decay line here. And of course, we're forcing it to go slightly in the money for the ATM bell curve. Those are my 3 core principles in action just on the options criteria for the radioactive screen. I made some subtle adjustments for my needs. But let's go ahead and submit that. Following the other criteria that we're using, not too bad. I've narrowed it down to only 3 positions. Yandex, Qualcomm, and Fabrinet, with that July 70 put that we just looked at in the previous example. So since we already started with FN and we showed why I wouldn't be buying a January put 31 days out in time, why if I decided to go to July to follow the radioactive decay line, the time decay line, I'm not going with the 60 put, which was about an 18% risk. I'm not going with a 65 that had the highest time premium. I'm looking at the 70 or the 75 for around that 5, 6, 4% at risk. Now, if something just comes up on this screen, do I consider this a recommendation? Am I going to go ahead and jump on this right now? No, I'm going to do some quick research and analysis. Use that more information button. I'm going to take a look at the stock chart. I'm going to take a look at the company information and news to make sure that there's nothing out there that would cause me hesitation on the position. I do see that earnings are coming up in 48 days, but guess what? I'm not bothered by that. Even in the worst case scenario, the most I can lose is that 5, 5.5, 6% on the position. More than comfortable with that. So one thing quick, I might just look at the chart very quickly, and I'm just looking to make sure that it's going in a trend that I expect. Even though I have the 70 put, which is up here, is this the kind of stock that I'd want to see for continued growth going forward? Absolutely. If I'm wrong and the stock falls, might only lose 5.5% in the absolute worst case scenario. That is a proper protected structure. That is what I'm looking for going into a new position. Okay? Now let's talk about that for a moment. Let's talk about what we don't know what's around the corner. Whether we're talking about tomorrow or whether we're talking 15 days from now when we're in 2020 or 25 days from now. Expectations of what could happen. Let's take that Fabrinet position. And I'm going to go right to our profit and loss chart here in PowerOptions. Sorry about that. All right. So again, yes, the break even now would be at 74.35 with the cost of the stock now up to 64.35 from we saw it this morning at 63.88. put option has declined, so I really only increased the risk by 25-35 cents. It's at 5.9% now, bouncing around with the real-time prices. Well, we talked about how that break even may be at $66, $67 at the halfway point, but that's still 4 months away. What would we expect to happen if Fabrinet drops, let's say, $4, about 7-8% in the next 30 days? All right, so we drop down to $60 per share. Remember, our maximum risk here is $4.35, 5.9% on the position. But let's say by January 17th, the stock falls 4 points. The unexpected happens in 2020. Of course, my put's going to increase. Where's my loss? It's less than half of that maximum loss on the position. Using the Black-Scholes pricing model, an expectation of where my put would be priced. And if the stock falls, this volatility might increase a little bit, might go up to 0.36 or 0.37. But of that 435, I'm only losing 209 because this is not just insurance. It's a second asset that I'm going to be able to use to manipulate the position. But what if the opposite occurs? Stock moves up 4 or 5 points, 7 or 8% in the first 30 days. Let's say it hits $69 on January 17th. My put go to zero? No. I'd only lost about 30% of its value, 20% of its value. Still at a reasonable profit here based on the Black-Scholes pricing model. I'd expect to see a little bit more because my delta is probably only around 0.56 or 0.57. I'm still going to be able to make 60, 55% of the gain in the underlying stock, but with that guaranteed exit and protection and plan, which isn't just insurance. It's a second asset that might lose value as the stock goes down. Might lose value as the stock goes up, but not one-to-one. And is it going to gain value when the stock falls? Yes, not one-to-one, but it's going to keep it so this maximum risk and this break-even that I'm worried about is only true if I hold the position all the way to expiration and make no adjustments. Do nothing to help lower this initial at risk and generate premium on the position. So that's how it's a second asset that's working in your favor. It's not only better than a stop order because it's guaranteed, even in those overnight 10-15% declines. The proper protected structure is a second working asset that can be manipulated as the trade goes on to help you lower the break-even, lower the risk on the position till we could eventually become bulletproof, cancel all the risk on the trade, still have unlimited upside going forward with no fear of loss to the downside. That's what we call bulletproofing in the radioactive techniques. Now real quick, let's go back to our married put search. And we've got another one here on Yandex, good price at 42.40. High risk though, for my personal taste, around 7.3%, but that's equal to the Qualcomm position that's at 88.23. But this is interesting. Qualcomm is carrying a 7.3% risk from the July series, same as our Fabrinet position. But the Yandex position is out to January 2021. So we have a year and about a month before we hit expiration for the same risk at 7.3%. Slightly longer term trade. But let's take a look at the recent chart for Yandex. And we've got a good pop-up from earnings recently. We've got the trend that we want. It's had a pullback after that sort of Bollinger Band breakout, and it's starting to trend down a little bit. Maybe that is condensing force, starting to condense a little bit. But it has been on a good run in the last few months, hasn't it? It's gone up from 29 to 43, so we're almost at 65-70% gain in the last 3 months on this particular position. Did we miss the boat? Maybe. What is the one thing everyone says? Well, should you really be buying stocks even if it's protected if the stock is hitting new 52-week highs? Keep in mind this new 52-week high is only the 52-week high until the next 52-week high. If this stock gains another 30, 40, or 50% in the next 3 or 4 months, do I want to miss out on that because it was hitting a high today? Not necessarily. Am I going to take a chance of just buying a stock that's hitting a recent new high or it's just come off a recent new high going forward without knowing what could happen next? No, I'm not just going to buy the stock in that case. I am going to enter it as a proper protected stock position. So I have time on this one. Even if it's pulling back a little bit from these highs, it's not quite streaking as much, but it's been on a strong run. Just very quickly, let's take a look next at Qualcomm. I just want to see the chart there as well. Personally, I'm less comfortable with this. It's had a great run as well, but it came off of that high, and we saw that decline recently, and it's trying to fight back. But a lot of the market today is pulling back. The MACD looks good. But anyway, let's not get too deep into it. Although Qualcomm looks good, matching the criteria, remember I changed. We had 14 results when we first started, but some of those were outside of my personal trading range. I had to lower the stock price expectation. I put the risk in my wheelhouse for what I want to see for the proper protected stock. Nothing wrong with taking an 8% risk or even a 7.3% risk. But again, having 395 days with the 7.3% risk, I think I'm a little bit more comfortable right now with the unknown coming up and taking the same amount of risk for 180 days less, almost 6 months less out in time. So, without going too deep into the discussion of it, but I promised that I'd make 2 potential trades today. What I'm going to do when we get off the webinar is I'm going to go to my broker. I'm going to enter the Fabrinet Married Put position, try to get as close to the midpoint as possible, carry a 5.86% risk by purchasing shares of stock and purchasing the July 70 put option. And then I'm going to also enter the Yandex position. I'm going to enter a bid and an offer, of course, for the stock. I'm going to try to get this January 47 strike put. 5 points in the money, roughly. Okay, let's call it 460 in the money right now with a price of 830. So only 370 of that is the time value. Only 370 is the risk for 7.3%. Those are going to be my targets. If I get a little bit better, I'm going to be happy. I'm not going to try to go more than 6% on this one, and I'm going to try to keep it right around 7%, toggling the midpoint prices for the Yandex position as well. Those are the 2 married puts I'm going to look to open for our Fusion subscribers at RadioActive Trading, and I'm going to post those as soon as they are filled this afternoon. All right. Now, another thing I wanted to address real quick, I know we're coming to the end of the presentation, but another fantastic tool that we have, let me go back to Fabrinet. And let's say that when I saw the MACD starting to change the first time, I was following this closely. Let's say I was following this closely. When I saw the MACD and the stock move above here and above the Bollinger Band, I took that as a trigger to buy into the stock. And let's say we got in, let's call it $55 per share back in the middle of October. Now, towards the end of October, probably right after October expiration. Let's say that I bought shares of Fabrinet at $55. And a lot of stocks have been on this run in the last month and a half. We've seen Tesla rocket around, but really start to move up. We've seen the other positions, including SPY, just move up very strongly in the last month or so. So, I'm sitting on shares at $55. I don't know what's going to go in the new year. I'm hoping the trend continues. But right now I have about a $9 unrealized gain in the stock. Do I want to chance that? Okay, well maybe let's put in a trailing stop order. Let's go ahead and say that now the stock at 64, I'm going to sell to close it if the stock drops below 62. All right, well what happens overnight? Something happens over this weekend. I'm not doom and gloom, mind you. But if something does happen, and all the stocks pull down and we see FN for whatever reason drop down to $58, $59 per share, well, I still have a gain, but that stop is triggered. I don't get out at 62, do I? Now I get out whatever the market's ordering. That stop order or trailing stop is now a market order that tells them to get out of the position. And on Monday it opens up at 57. That's what the market can give me. I've got a $2 gain, but the stop order didn't help me. What I could also do is use this nifty little insurance tool we have here on PowerOptions and on RadioActive Trading. And I can just tell it, well, I've got FN. I bought it for $55 per share. Show me what I can do here to lock in gains, leave my upside open. Well, we've got an unrealized 16.9% gain on the position. Now I can go near term and cheap. that might be okay, because for the next 30 to 40 days, buying the put options near term, I can have a guaranteed locked-in profit, 13%, 13.5%, almost 15% of the unrealized 16.9% gain on this position. That would mean no risk and a guaranteed profit even if the stock falls, while still having unlimited upside profit potential. But let's say one thing that we did know was what? We saw that Fabrinet does have earnings coming up in about 58 days into February. So looking at the days to expiration here, right now, we'll see a February expiration after December expires, but right now we just have January's, April's, July's, and of course those Novembers that were 339 days out in time. So let's go ahead out to April. 4 months out, 122 days. What does that do? That covers me through earnings. Stock trading at 64. I've got a cost basis of 55. Unrealized 16.9% gain. Tool immediately showed me that I can lock in almost an 11% gain on this position, buying that April 70 slightly in the money, go through earnings with a guaranteed potential profit of 11%, even if the stock falls 33, 35, or 40% from poor performance. But if it jumps 10, 15%, we still have unlimited upside. I'm 4 months out in time, so that time decay curve is still on my side. I'm slightly in the money, so I'm following the at-the-money bell curve as well. And if we look at the profit and loss chart here, we're going to see something that we all strive for and would all love to see. Bulletproof position. No risk. Negative risk. Guaranteed profit going forward. I don't have to hold this for 4 months. I can hold it just through the February earnings. The stock jumps another 10, 12% due to earnings, or even in a build-up before that. I can still use this put as a second asset to lower this risk and increase guaranteed performance. Or if the stock falls, I could get out of the position with my minimum 11% return. It might be higher than that because not all the time decay has come out yet as well. That's an advantage of using the proper structure on an unrealized gain you have when you don't know what's going to happen, and we never do, but we don't know the unexpected of where the next year could take us. Are these trends that we've seen going to continue? Is it worth risking my unrealized profit and stocks that I'm holding to a trailing stop or stop order if the unexpected happens? Black swan event, something changes, inverted yield curves, fear of recession peaks back up, stocks start to pull back, hesitate or more. I've got a guarantee. In this case, a guarantee that the worst absolute thing that I could do, even if I disappeared, went into the hospital, I was in the hospital through May and wasn't looking at my trades, the worst thing that could happen now is I'm making 11% on this position. The best thing is I could make much more than that if the stock continues to move up in price. Oh, sorry folks. My apologies on that. Didn't click over as fast as I had wanted it to. So that is what we're talking about with a proper protected stock position. Whether opening new trades, going forward with a proper expectation, the controlled risk, minimized outlook, application of the 3 core principles, which should really be for any options investing strategy, but that is the application. As I mentioned, am I just going to open these 2 married puts on Yandex and on Fabrinet and let it go? No. That's why we discussed the 12 different income methods or adjustments in the blueprint, the proper way to sell premium. There's an improper way to generate income against this structure. We're going to talk about that on Thursday as well. But you have the full ins and outs of the 12 different income methods, when to use them, how to apply them, what targets to look for to generate the proper income or manipulate your second asset, the put option, to lower that risk, still leave the upside open. In the blueprint, there's a chapter on combining income methods to maximize more return, when to exit, when to adjust, full discussion on the proper structure beyond what I just gave you today, more insight into the stock selection process and more, and of course a full appendix with trade examples, real-world examples, not only of the structure, but of the income methods, what happened over 5 or 6 month periods with certain trades. Ernie's got a full example, I believe, on HPQ there in the appendix that he tracked for an 8 or 9 month position and the adjustments he used. Everything you need to know how to not only get yourself into the proper protected stock structure, but also how to apply the adjustments, when we should consider doing one of those 12 different income methods, or maybe exiting the position itself to keep in the proper trading plan and full insight into real-world trades and more. And why might the blueprint be right for you? Well, because I don't want you to lose money. You guys did exceptional this year. Those that answered, we had 51% of you said that you were doing great or good. 13% last year beat the 28% return that we saw in SPY. But 50% of you were not doing good or were just meh. You weren't happy with those results. And what do you think? Looking forward, those of you that were even doing spread trades, but those of you that were doing covered calls and naked puts, think of your answers. Think of the results that you had and think of some of the losses you would have had. You did have, maybe from unexpected events. Would limiting risk to 5 or 6% have increased your answer from maybe not good to meh, and then maybe from meh to good, or from good to great? Why is the blueprint right for you? Because you don't want to lose money. You don't want to give up the unrealized gains you might have experienced in the last year or on positions you're holding that have seen that nice move up in the last month and a half. We want to be protected from the unknown. This is the best structure. Not only a guaranteed insurance much better than stop order, but it puts you in a position that gives you a second working asset that can be manipulated as well. If the unknown comes, we want to have the right tools to meet our goals, not just rolling down a covered call or rolling up, adding to our cost basis, running the risk of rolling down and having the stock spike back where we might be assigned and locked into a loss. All of that without worry or without fear. And time is on our side. No pressure to do anything. If I'm in one of these two protected positions, the Fabrinet or the index, and the stock doesn't move for the first 30 days, I could exit with only maybe a 0.5 or 0.6% loss in that scenario, or I could choose to do nothing. Or I could actually lower my risk by doing something else as well, even if the stock hasn't moved. Now, I'm just curious on that last thought there. Just wanted to know. Let's see if you want to tell me. But I want to know, what do you think about the proper protected stock position? Is this what you need to change a good year to a great year? Would this structure applied to your positions or a portion of your portfolio have turned a losing year into a winning year? Do you like the concept of the proper stock approach, proper protected stock approach, but you're concerned about how you'd pay for that protection, how you'd pay for the insurance? Or do you think the insurance is a waste of time premium? Now, of course, I've already kind of covered that with the fact that the reason why I'm buying something that's far out in time is because I'm putting time on my side. I'm not worried about the decay in the first 30 to 40 days as well. That's still going to keep me at a low risk of maybe only 0.5, 0.6% on the position. Excuse me, folks. All right, so I've had the poll open for about a minute. I've got several of our attendees answering here, but let me go ahead and close the poll and share the results with you. 50% of you, the 50% of those that answered, said that this is the structure that was needed to change a good year into a great year. And we had 25% of you say that this would have turned a losing year into a winning year. And 25% said, great, but how do I pay for the proper protected stock position? Okay, well, let's do this first. For those of you that answered this is what you've needed, and that you even think that it's great, of course, naturally, I just wanted to remind everyone that now is the best time to pick up the blueprint. You go to RadioActiveTrading.com and hit the Products tab. End of the year promotion, that big end of the year offer that we have here, you're going to be able to take advantage of 8 special bonuses that have not been available. You're going to be able to get 2 months of access to the Fusion subscription for only $10. What is Fusion? Well, that's where Ernie, myself, and other PowerOptions RadioActive Trading staff post our trades. It's a learning tool. You can see how we apply these techniques in our personal account. There's also a series of lessons there that you can access right away to help you get started and to help you master the radioactive trading techniques. Also, of course, if you pick up the blueprint or go into Fusion, but once you start your Fusion special there, you can also see special members-only webinars and presentations that aren't available at other places. We have put together 6 Mastery Series videos that go a little bit more in-depth into the income methods. That's what's included in the Home Study Kit. You get the blueprint and those 6 Mastery Series videos. You're going to get the first one, the Foundations of Radioactive Trading, for free if you pick up the blueprint. Also, special, the FIST video. It's a compilation of our most requested replay webinars, 4 additional webinars on there, plus a bonus one as well. We'll send you something called the Quick Start Guide to help you start getting started faster, where you feel confident, even before you start going through the blueprint, of potentially opening one of those positions on the search tool and researching and analyzing it to go forward. You saw the tools today on PowerOptions. We didn't even show the portfolio tool that can help us track and manage the positions and evaluate income methods for us, where all the math is done for us, and we can see a side-by-side before and after picture. You're going to get 1 month of PowerOptions for free. Instant access, number 6. The blueprint is now an all-electronic version. When you purchase the blueprint, we'll send you a link to access your copy of the blueprint. Most updated version, of course. This means no shipping. No waiting for the shipment to arrive, as some of us are probably doing for Christmas presents, biting our teeth hoping they come in time. And of course, no bulky binders to carry around. Information, different income methods, different chapters, always at your fingertips. Of course, you receive email and phone support for free. As a blueprint owner, if you have questions about the radioactive trading principles, the setup of the structure, the income methods, management techniques, you just want a second set of eyes on your trade saying, hey, I was thinking about doing this, but I don't know if I'm in the right place, or is it time for me to do this now? Well, that's all completely free as a blueprint owner. Also, instant access to members-only content, as I mentioned, but even if you don't access Fusion, you don't activate that first 2 months of Fusion for only $10 right away, as a blueprint owner, there's about 7 or 8 blueprint members-only webinars that you can access right away at Radioactive Trading as a blueprint owner, and you can start going through those immediately, although you probably want to wait to get through some of the content of the blueprint before some of the more advanced members-only presentations. And of course, I've got much more for you. That special offer that I mentioned applies to those of you, that 75% that said, this is what I need to change a good year to a great year. How do you want to answer that question when I ask you next year at the beginning of December 2020? 25% that said this would have turned a losing year into a winning year. Yeah, this is right up your alley, and this is what you want to jump on right now. And for the, you're going to see the archive. I'm going to send you the archive as soon as it's posted there. It'll probably be around 3 o'clock this afternoon Eastern Time. I'll let you know how you can access the archive to go through this material again. But that special offer really applies to those 75%. For the 25% that said, great, but how do I pay for that proper protected insurance? Thursday at 12 noon Eastern Time. Once I get these positions in, we're going to talk about, is it time for an income method? We're going to look at the 2 positions, and if it's not time for an income method, that's okay. We're going to talk about why. We're going to talk about some of the 12 income methods that might be considered, but I'm not going to give it all away for free, let me say that. And on that last poll, no one said that they think insurance is a waste of time premium. So yeah, you guys are a savvy audience. You all got it. The proper protected structure is not a waste of time value because of what we saw last year. Think back to that Macys position, what we saw with that roller coaster on GE, the ups and the downs, and even on that Dell position. Having the proper structure in place, you could have withstood all of those movements. That 50% decline on Macys would only be about a 5 or 6% loss to you. And you probably could have gotten out earlier after that first 25% decline for likely only a 4% loss. You weren't at the full loss yet. Dell position gave us a lot of opportunities to adjust up and down, as would have the GM position. So for those 25% of you, go to radioactivetrading.com. You'll see the registration link for the next webinar coming up at Thursday at 12 noon Eastern Time. Is it time for an income method? Now, of course, you might have questions. I'm not going to be available on the phone for the next 25 or 30 minutes or so, but if you have a question, remember, email me at any time to support@radioactivetrading.com. You can call the office, of course. Ernie, Greg, or one of the other staff members will be more than happy to help you out, and I, of course, will be available later. But again, for the 75% of you that said this is what you need to change a good year into a great year, or this would have turned a losing year into a winning year, go to RadioActiveTrading.com. Click the Products tab, pick up the blueprint. It's the best time to get it. It gives you advantage of the 8 special bonuses that we're offering that end, however, on December 31st. So take advantage of it now. You can start going through those instant access right away, members-only content and more, and you'll be prepared for what we don't know is going forward. But if you plan on opening any new positions, you'll have the proper protected structure in place, remove the fear from the unexpected, be able to withstand some of these volatile moments that we still even saw in 2019, despite the great trading performance and the great increase. But as we saw, it did not happen with all stocks. Ladies and gentlemen, thank you for your time today. Again, we'll let you know as soon as this archive is available so you can go back through it on your time. Remember, the special offer ends December 31st. And also, feel free to join me on Thursday. Just go to radioactivetrading.com, register for our next webinar at 12 noon. Is it time for an income method? I've got to go open my trading account, try to put that Fabrinet and that Yandex position in, post it for our Fusion subscribers. I hope to see you all on Thursday. Take care, everyone. Good night.